Lesson 1. Fibonacci. Fibonacci was an Italian mathematician famous for discovering the Fibonacci sequence. The sequence looks like this. Every number in the sequence is simply the sum of the two previous numbers. So 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, and so on. The sequence itself is not that important. It's the ratio of these numbers that matters. If you measure the ratio of any number to the succeeding higher number, you will get 0.618. If you measure the ratio between any second number, you will get the ratio 0.382. This is called the golden ratio, or the golden mean. It can be found in everything in nature, starting from Adam and Eve's male to female behavior ratio. So, why am I telling you all this? As you may have guessed, the same ratio is believed to work in the Forex market. Traders use the Fibonacci ratios to find the potential reversal points in the market, as the price tends to find support and resistance of these levels. The 5 key Fibonacci ratios are 23.6%, 38.2%, 50%, 61.8%, and 100%. Take a look at this chart. You will notice that the Fibonacci retracement is considered between the low and high, and the price starts reversing from the 61.8% retracement. The best way to use the Fibonacci levels is to draw separate swings towards the end of the moves. Also, look for the levels that overlapped at these levels, and generally they should provide stronger support and resistance. Take a look here. We draw the first Fibonacci from the start of the uptrend all the way up to the most recent high. Then we draw the second Fibonacci from the most recent swing low to the most recent swing high. Both the Fibonaccis will have an overlap at a point which is considered to be a strong support. Now, you can either wait for the price to retrace this level to go long, or if you're already long, you can put your protective stops under this level.